Yeah, so my kind of sweet spot of investing is kind of companies that are between $1 billion and $20 billion, roughly. That is the rough area that I am looking to deploy new capital, although not exclusively. The amazing thing is, if you take a company like Amazon, when Amazon was a $160 billion company, it went on to 10x. 10x from 160 billion. Apple 10x from 220 billion. So what I am looking for in an investment, or how I would deploy capital today, would be to look for companies that I would say, I like everything about this company. I think that 5 and 10 years from now, this company will be significantly bigger than it is today. And given the size of the market cap and the opportunity, if I'm right about this investment, I believe that a 10x return over a 10-year period is entirely possible. So one company that I like right now, for example, is called Fiverr. The ticker symbol there is FVRR.
I'm vested in that as well.
Great. I think that there's a lot to like about that company. It checks a lot of the boxes in what I'm looking for. It's run by its founder. It's nearing or at profitability. It's nearing or at free cash flow productivity. The stock has been a massive winner. They are one of the leaders in their industry. They are grabbing market share from the traditional way of doing things. And I think they're a natural beneficiary, a long-term permanent beneficiary of the shift to remote work. So that's a company that's, and the market cap of that company today is about $10 billion.
Yes, 10, 11.
So I'd ask myself, okay, if this company continues to succeed, could I see this business being worth $100 billion in 10 years? To me, the answer is yes. If they can keep their growth rate, their revenue growth rate at like 30% or thereabouts for the next 10 years, I could see this business 10xing over that time period. So I would deploy some of my capital into that. Importantly, I wouldn't put all my capital into that, because whenever you're making an investment, it's just it's playing the odds game. What are the odds that I am right about Fiverr? I think the odds are favorable, but they're not 100%. They are not 100%. And if I'm right about Fiverr, and I devote a small part of my portfolio to it, that will grow into a much bigger part of my portfolio over time. So I would steadily add money to Fiverr, say every quarter or so, as long as the thesis for me owning the stock was on track. And if I ever got the hint that my thesis was wrong, I would have no problem admitting defeat and saying I was wrong about this one and selling it and deploying it into another idea. But I would want to own a number of companies that had characteristics that were similar to Fiverr, and just hold them voraciously, and eventually the winners will emerge, and they will capture a higher and higher percentage of my portfolio. So that's how I would concentrate my portfolio over time, is to make lots of high quality bets and let the companies that execute carry my portfolio higher.
That's amazing. Now, the Fiverr business is good. I mean, there is a bit of fear about Fiverr business that it might be post-pandemic, how the business will, the gig economy probably might, may not grow as much as it has grown during the pandemic time. That's fine. I think it's a bit of fear, and there will always be some fear. How about valuation? What valuation metrics would you look at Fiverr to evaluate? Price to sales? What level? What matrix?
Yep. So valuation is very much an art and not a science in my opinion. And again, it totally depends. If you look at the valuation of Fiverr right now, according to Yahoo Finance, it's currently trading at 54 times sales and about 1,700 times forward earnings. And if you look at those numbers, boy, do they seem scary. Those are very, very generous valuation multiples. But what that's telling me is that Wall Street is assuming that this company is going to continue to succeed for a long, long time. When it comes to Fiverr and the valuation, if you agree that it's a good stock, I would have no problem buying some today, because what I'm focused on is the market cap and the opportunity. Again, the market cap here is 10 billion. If I think it can get to 100 billion in 10 years, that's still a 10x return. And even if that valuation multiple compresses significantly over that time period, if the revenue and margin growth is strong enough, the company should be worth far more down the road than it is today. But that's the reason why I wouldn't go jump in all at once. I would buy some today, and then I would watch it. and I would see, is my thesis correct about this company? But if Fiverr succeeds in growing its revenue 30%, 20 or 30% compound annual growth rate over the next 10 years, today's valuation will look completely reasonable in hindsight. But that's really hard to do. If you look back at the biggest winners over the last 10 and 20 years, I mean, how many times could you have said Amazon, overvalued right now, trading at 1,000 times earnings, and that was 100 bags ago? Like literally, Amazon looked expensive the entire way up. So I would, again, focus mostly on the market cap and where I think the market cap could be, and pay attention to valuation, but not let it dictate my decisions.
So if let's say, I mean, this is a question I face all the time. Let's say 2 years down the line, company is growing very well, and it's still at a valuation of, let's say, price to sales of 45 to 50. Would you still put more money in if it's growing 35% compound?
Yeah, so the price to sales ratio is a useful metric, but it's not the only metric that I look at. With Fiverr in particular, you have to remember, or the thing that I keep in mind is that Fiverr has a gross margin that's 80% or more. When you compare that even to a company like Amazon, Amazon has a gross margin that's in the maybe 30 or 40%. So based on that fact alone, when Fiverr makes $1 of sales, it can deploy 80 cents of that dollar in sales back into the business or on behalf of shareholders. Compare that to a company like even Apple. Apple has a gross margin of 40% or so. That means it has 40 for every dollar in sales. It has 40 cents to deploy back into the business and to give to shareholders. So that fact alone means that it should trade at least double the price to sales ratio of some other companies. So price to sales ratio is a useful metric, but I will also look at price to earnings ratio, price to free cash flow ratio, and I will let the combination of a few metrics judge what I want to do. Price to sales ratio is useful when it's the only metric that you can use. It's less useful once a company is optimized for free cash flow and optimized for profits. Fiverr isn't there yet. Fiverr is nowhere close to being optimized for free cash flow and profits. It's optimized for growth. That's why the price to earnings ratio on it looks so absurd right now, because it just barely crossed into the free cash into positive. A few years from now, once the company hits much larger scale, could it be producing a 20% net margin or so, or keeping 20 cents out of every dollar in sales as profits? I could easily see that happening. If that's right, then that means that the earnings of today are understated by at least a factor of 20. So therefore, the price to earnings ratio is overstated by a factor of 20. So I always look at the valuation metrics, but again, I'm more focused on where I think this company can be in 5 and 10 years than where it is today.